Most people make investing way too complicated. They chase hot stocks, follow hype on social media, and panic every time the market dips. But the world's most successful investor, Warren Buffett, says most people should do the exact opposite. In fact, he says he shouldn't try to beat the market at all. So in this video, I'm going to break down how exactly Warren Buffett thinks you should invest and why it's so simple, powerful, and proven to work. Warren Buffett is famous for picking stocks like Coca-Cola, Apple, and American Express and holding them for decades. But when it comes to advice for everyday investors, people like you and me, he says this. For most people, invest in a low-cost S&P 500 index fund and keep doing it consistently. Let that sink in for a second. This is a man with over 100 billion to his name. And yet, he's telling people not to day trade, speculate, or time the market. He's saying, keep it simple, keep it consistent, stay in it for the long run. That's it. So why index funds? Or more importantly, for the new investors watching, what exactly is an index fund? An index fund is a type of investment fund like an ETF that is designed to track the performance of a specific market index like the S&P 500 in the US or the ASX 200 in Australia. The S&P 500 index that Warren Buffett specifically mentions is basically a basket of the top 500 companies in the United States. So think of large well-known companies like Apple, Microsoft, Amazon, Google, Walmart, and Visa. By investing a single share, you get a small slice of all these great companies. When you invest in an index fund like the S&P 500, you're not just betting on one company. You're basically betting on the entire US economy. Warren Buffett loves index funds for three main reasons. 1. Low fees. Actively managed funds can charge 1 to 2% annually. That might not sound like much, but as your portfolio grows over 30 years, it could cost you hundreds of thousands in lost gains. Index funds often charge around 0.03%. Huge difference. 2. Diversification. Instead of betting on one stock, you're spread across 500 companies in all sectors. If one company fails, the others can carry you. 3. Proven track record. Over the last 100 years, the S&P 500 has averaged around 8 to 10% per year. So if you invested $200 per month for the next 40 years, with an average annual return of 10%, you would have approximately $1.2 million. And the best part is, you would have only contributed about $96K. The rest of it, over $1.1 million, would have come from compound interest over time. That's how powerful investing consistently, long-term, can be. In 2008, Warren Buffett made a bet that shook the financial world. He bet $1 million that a simple S&P 500 index fund would outperform a collection of hand-picked hedge funds over 10 years. Now remember, hedge funds have teams of analysts, tons of data, and charge big fees. So who won? Warren Buffett's index fund crushed the hedge funds. By the end of 10 years, the S&P 500 returned 125%. The hedge funds, just 36%. Let that be a lesson. Even the smartest professionals often can't consistently beat the market, especially once you subtract their fees. This isn't just public advice, it's what Warren Buffett has told his own family. In his will, he left instructions for his wife's inheritance. Put 90% of the money in a low-cost S&P 500 index fund. Another 10% in short-term US Treasury bills. That's it. No complex trusts, no hedge funds, just simple, boring, consistent investing. Here's how you start investing the Warren Buffett way with these 4 steps. Step 1. Sign up to an online broker. In Australia, there are many online brokers you can use to invest in shares. However, not every broker was created equally. I'm currently using the Moomoo app to do all my investing since they tick all the boxes that I look for in an online broker. 1. They're CHESS sponsored, which means the shares you buy from this app are registered directly under your name on the ASX. This provides better security as no one can dispute who the shares belong to in the future. Not all online brokers in Australia offer this. Some keep your shares under your broker's name. 2. They charge very low brokerage fees. For Aussie stocks, they charge a minimum of $3 per trade for Aussie stocks and a minimum of 99 cents per trade for US stocks. This is one of the lowest rates in Australia. And 3. They recently released an auto-invest function that automatically buys your favorite stocks or ETFs for you every fortnight or month. This is ideal for beginners who want to follow Warren Buffett's advice to stay consistent. You simply set it up once and let the app do its thing for you. So if you're interested, they currently have some nice sign-up bonuses. If you sign up using the link in the description, you'll receive up to 30 free fractional shares when you make a qualified deposit, plus 8 more if you share a post on social media. You just need to keep a minimum account balance for 30 days. You'll also get $0 brokerage fees on Aussie and US shares for 30 days. So that's free brokerage fees for a month for you to try out this app for free. And if you don't like it after trying for 30 days, no worries. You can simply walk away and keep the free shares. No hard feelings. That's a pretty sweet deal. Please note, terms and conditions do apply, so make sure you read them before proceeding. I'm not sure how long this offer will last, so if you're interested, use the link down below to sign up and claim all the free rewards on screen. Enjoy. Step 2. Pick your fund to invest in. In Australia, the easiest way to invest in an index fund is through an ETF. An index fund ETF is an ETF that mimics a specific index, such as the ASX 200, which is the top 200 Australian companies, or in Warren Buffett's case, the S&P 500, which is the top 500 US companies. I would encourage you to do your own research on the different index fund ETFs available to Australian investors if you want to follow Buffett's advice. You have two main options. You can invest in an ETF either directly from the US market or through the ASX, which is the Australian stock market. Here are the differences. 1. Currency. ASX listed S&P 500 ETFs like IVV and SPY ASX version are priced in AUD but still hold US stocks, so you're exposed to USD movements. US listed S&P 500 ETFs like VOO and SPY US version are priced and traded in USD, meaning you need to convert AUD to USD to invest. The bottom line is, you're exposed to US currency risk either way. The ASX version just handles AUD to USD conversion internally. 2. Tax. If you buy US listed ETFs directly, you must fill out the W8BEN form to avoid 30% tax on dividends. With the form, it's reduced to 15% under the US-Australia tax treaty. If you buy the ASX version, the fund handles the W8BEN form for you. You still get the same 15% withheld, but no form is required. For simplicity, many Aussies prefer ASX listed versions. 3. Fees. US listed ETFs have slightly cheaper management fees due to scale and competition. However, you will usually be charged a foreign exchange fee by your broker to convert AUD to USD. The ASX listed version may have slightly higher total costs due to currency conversion spreads or smaller fund sizes, but the difference are minor for long-term investors. 4. Convenience and access. ASX ETFs are available through most Australian brokers in AUD during Aussie market hours. US ETFs require platforms that support international trading and may involve foreign exchange fees, slippages, and time zone differences. Please note the US market opens when most Australians are getting ready for bed. So which one should you pick? It's up to you. It depends on your own preference. Make sure you do more research and pick the one that best suits you as an investor. Step 3. Set up auto invest. Warren Buffett generally doesn't believe in timing the market. Instead, invest consistently, weekly, fortnightly, or monthly. This is called dollar cost averaging. Dollar cost averaging is an investing strategy where you consistently invest a fixed amount of money at regular intervals, regardless of market conditions, to reduce the impact of volatility over time. For example, setting up an auto invest plan to automatically invest $200 every month into your chosen ETF. You can set this up with the Moomoo app and it'll take care of everything for you, which makes it super convenient. Dollar cost averaging is great for new investors because it reduces risk. You avoid investing a lump sum at the wrong time. It builds discipline because it encourages consistent long-term investing habits. It removes emotion. You don't have to time the market or react to short-term swings. And it smooths out volatility. You buy more shares when prices are low and fewer when prices are high. Step 4. Don't panic. The reality is, markets will crash. Sometimes dramatically. In 2008, the market dropped over 50%. In March 2020, it fell 30% in a matter of weeks. And there have been countless other corrections and bear markets throughout history. But here's what separates successful investors from everyone else. Successful investors understand that these drops are normal and temporary. When the market drops, Buffett says, be fearful when others are greedy and be greedy when others are fearful. So don't sell, stay the course. The worst thing you can do is panic sell at the bottom, locking in your losses and missing the recovery. Those who stayed the course through every major market crash of the last century have been rewarded. Those who tried to time the market, on average, severely underperformed. Warren Buffett's advice works because it removes emotion from the equation. You're not guessing, you're not chasing trends, you're just betting on long-term human progress. It's boring, but boring builds wealth. Most millionaires didn't get rich trading meme stocks. They got rich by being consistent, patient, and letting time do the heavy lifting. Quick disclaimer, this video is for educational purposes only and should not be considered financial advice. The ETFs mentioned are not buy recommendations and are examples only. Please remember that investing involves risk and past performances does not guarantee future results. Always do your own research, and if you'd like financial advice, please go speak to a professional. By the way, if you're enjoying this video and made it this far, comment the word GOAT down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit the subscribe button and join this awesome community of like-minded people. Also, please consider signing up for my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool life updates from me. And if you want to learn how to invest in ETFs this year, check out this video on screen where I'll show you a step-by-step beginner's guide on how to buy your first ETF in Australia. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.